Welcome to the FNO InsureTech podcast, a place where movers and shakers from all points within the insurance ecosystem gather and discuss all things InsureTech. We talk about how technology and innovation are affecting and driving change in the industry. Here are your hosts, Lee Boyd and Rob Beller.
Hey, podcast world, welcome to another remarkable, astounding, interesting, thoughtful, deep, etc., episode of FNO InsureTech. I am Rob Beller, one of your two hosts.
Yep.
One that you can count on almost every week except when I'm not here.
That's right. Which hadn't happened in a while.
No, I'm on a roll.
I'm on a roll. Or did we actually, you started telling us when your vacations were and Alicia stopped scheduling them when you were gone. So we thank you for giving us access to your calendar.
Sure. Pleasure. And let me introduce my co-host, Mr. Lee Boyd.
Hi, everybody. Thank you. Please hold the applause.
I don't hear any.
It was there. Well, they're in their car. They're in their car, you see.
Is that what it is?
Or at their home. I don't know.
Do you think people listen to this when they're in their car?
I think they're on the train. I think when they're driving, if anybody actually drives to work. I think when they're walking on the treadmill. I think all those are podcast times.
How about in their sleep? Do you think anybody listens to it in their sleep?
Maybe soaking in a nice warm bath. I don't know. I don't know.
Maybe. I think Astrid does
bath bomb.
Astrid does it with a glass of wine.
A glass of wine, feet up. I mean, there's a lot of different times that you could listen to a podcast.
You know when I listen to FNO InsureTech?
Never.
No, I listen to every episode before it goes out. Do you want to know when I listen to FNO InsureTech?
I do. I think it's on a treadmill.
It's when I work out.
Okay.
That's when I listen to it.
I used to, but then I got distracted, and so I stopped. I normally listen to it in the car and on that long drive home every day.
None of that has anything to do with our guest today.
Not a thing.
None. Sorry, Andrew. We have a luminary with us today. Now that I think about it, we are in the luminary phase of FNO InsureTech podcast.
The season, mind you, the season.
Yeah. We're doing an arc.
Season of luminaries.
A luminary arc. We have a VC luminary on with us today. Andrew Lerner is a pioneer in the industry, been investing in InsureTech for a very long time, fintech and InsureTech, since like the 90s, right?
Many, many years before InsureTech was a thing.
Before there was even a word. He's one of those guys.
Mm-hmm. We've had a lot of those on.
And he's with us today.
Yeah, he's from IA Capital Group. And he's going to come on today. We're going to get to ask him, what does he look for in companies? What's the mindset? What does IA Capital do? We're going to get to talk to him about all sorts of things. So I'm excited.
Including chess.
Yeah.
The guy's like a chess champion.
Yeah, we're going to play one day. You and, not me, I'm going to watch. You and him will play.
I think the world of venture capital probably has a lot to do with chess and playing chess well, right?
We might even ask moves. We might even ask them. Yeah, we might ask about that.
Well, if you're wondering if we're going to, then you're just going to have to listen to the rest of the podcast. And so we're going to stop our jibber jabber and move right to it. Without further ado, here is our interview with Andrew Lerner from IA Capital. Hey, everybody. We're here with a luminary in the InsureTech industry. And I only say that because he's been InsureTech investing since before there was InsureTech.
Long time.
Yeah. What did you call it back then, Andy?
Insurance technology.
Insurance technology. Wow. And somebody came up and said, you know what? We can say that faster by taking a couple of letters out.
Exactly.
We have Andy Lerner with us, managing partner at IA Capital Group. Welcome to our podcast. Thanks for coming.
Pleasure to be here. Thank you.
Glad you're here.
It's great to have you. And where are you today? We have to say this since we're recording this in winter when there's this horrendous winter storm going on. And we're on video and we're looking at Andy and the room he's in is super bright and light because you are where?
San Diego, La Jolla, California, and it's pretty rough avoiding the bad weather. Our offices are in New York on 42nd Street, but I am avoiding all that this week in California.
That's very smart. Very smart to do.
Very smart. I'm in California and it's freezing cold where I am. Mm-hmm. And you're in California, it's not freezing cold, right?
Yeah. No, it's beautiful weather today in San Diego.
Okay, so we're going to talk all about your company, some about you and some other stuff, but we have to start with the most interesting thing about you, if I can say so myself, and that's the Andrew Lerner Award. Can you tell us what that is?
In the chess world, if that's what you're referring to, Rob.
Yes, sir.
I'm a lifelong chess player, won some national championships when I was a kid, and it really made a difference in my life. So now as an adult, I want to give back to chess educators and chess volunteers. So through Chess in the Schools, an organization where I'm a nonprofit where I'm a trustee, we set up the Andy Lerner Award for volunteers or people that work in underprivileged communities to teach chess. So it's just a way of me giving back to something that made a big difference in my life.
That's phenomenal.
That's really cool. Is chess big today?
Pandemic, it got really big. I just read that this chess.com, the biggest online platform, passed 100 million users. That's a lot of people.
Wow. Yeah. That's a lot of people.
Yeah.
We actually pulled out the chessboard. It was maybe 2 weeks ago. Me and my son. My son learned chess in school. He was in classes, and that's what they taught in one of the classes was chess. So we actually pulled it out just a couple of weeks ago. And for the first time, I mean, he just beat my socks off. And I didn't have to pretend or anything, but it was really fun. It was really fun to get that back out and play.
It's been great for me. I play a little bit still. I'm a chess master, play on the internet, but lifelong passion.
You play competitively?
I don't play professionally or for money, but I play fairly often on the internet.
So we might not have mentioned that part of the price of doing our podcast is giving us chess tutoring.
Yeah.
But we won't bother our audience with that. We'll cover that offline.
Yeah, that'll be after.
There's a big cheating scandal going on in the world of professional chess where some 19-year-old beat the world champion and he got accused of cheating. And it's just a huge story.
Do you have an opinion on that? Do you think that he was a cheater?
I think in that particular game, he probably won it legitimately, but I think his whole character is being called into question, and I don't know him personally, but I think he won that game fair and square. This is my personal opinion.
I did watch The Queen's Gambit.
There you go.
That's as close as I'll ever get.
Yeah, very, very popular sport. And the game, it's a very popular game, and there's a lot of overlap between, I think, technology world and chess. A lot of technologists are chess players and vice versa.
What got me interested in when I read that about you is that connection between the two. Can you talk about that for a second?
Yeah, I just think it's just a quantitative mind. I was a computer science major in college. I was in School of Engineering at Princeton, and just a high level of correlation between interest in technology, numbers, quantitative fields, math, and chess. So it's all related. Of course, my son, who's a mathematician, wants nothing to do with chess, right? Probably because I'm a chess player.
Oh, really? He didn't grow up with the intent of teaching his dad a lesson? No,
he's a quant, but not a chess player.
I mean, isn't that chess, right? You're always thinking 2, 3, maybe 4 steps down the road. And whenever you're investing in a company, that's what you have to do. You have to think not today, but you have to think 4 or 5 steps down the road. Where are they going to go? Where can I take them? And how will it influence others? Isn't that right?
That's exactly right. And it's, investing is part art and part science. And I think, chess is, it's figuring out the moves and anticipation, but some of it's, creativity and, it's not all about the numbers.
What about luck? Is there luck in it too?
Sure. There's luck in everything. And I've been fortunate to have some investments where I think we did a good job, my firm investing, but also, fortunate to, it's good to be lucky too.
That's true.
Right. I mean, you could have been killing it in an investment pre-COVID, but something that was sensitive to COVID could have destroyed it.
I think that a lot of that happened, and vice versa. A lot of businesses that didn't take off, took off because of COVID. And, we invest in not only P&C InsureTech, but life InsureTech, health InsureTech. And our life insurer investors, they were not comfortable with online underwriting. But then when COVID came along and you weren't going to send a technician to somebody's house to get blood and urine samples, all of a sudden they're like, oh, we love online underwriting. And they accelerated, you had a 5-year plan to do it, and they accelerated that into six weeks and did it.
Yeah.
Did you see that from your perch about COVID in general, that it was an accelerator for the space?
Huge. These insurance companies that had long time frames really accelerated everything. And you can see that in the stock market and in valuations. Companies that had digital solutions just took off in valuation during 2020, and business models that relied on face-to-face interaction, went the other way.
So let's talk about IA Capital Group.
Sure.
Give us a minute on what it is, your history, and I don't always ask companies for their history, because sometimes companies' histories are about 20 minutes. They started 15 minutes before they were on the podcast, but that's not the case with IA Capital Group. So share that with us.
Yeah, we've been around a real long time, so I could take up 5 podcasts on the history. We've been around since the 90s. IA stands for Inter-Atlantic. Sometimes you'll see our investments under the Inter-Atlantic name. It's the same firm. Inter-Atlantic's a play on New York, London, Bermuda are the insurance capitals. They're all in the Atlantic region. So IA, we think, is a fitting name for a firm that focuses on insurance and insurance technology. Large majority of our investors are insurance companies. In our funds, we have 20 different insurance companies, predominantly U.S.-based insurance companies that invest with us. And we're now investing our 9th fund, 22 years of venture capital investing. We're the longest tenured, most experienced investor in InsureTech. Nobody else in InsureTech has, over a 20-year investment experience. We focus on U.S., Canada-based companies predominantly. Series A is our sweet spot, which some of your listeners might not know. That's usually a company with a few $1 million of revenue, but still a long way from being a public company or being sold 5 years or more, perhaps. We have over 30 investments in InsureTech. We also do some fintech. Over our history, we've made 57 venture investments. And then in addition, we see a great company, we seed it and help start it ourselves. So some prominent names in InsureTech, like Boost Insurance, are ones that we've actually seeded and incubated ourselves.
Right. I saw that you guys call that incubated investments, right, or whatnot.
Right.
So if getting involved in Series A, does that mean you like to get in there? You like to get in there relatively early when you can, because you like to be a very involved investor or investors. You like to help shape the future.
We like to help, but we don't want to step on the toes of the management team. It's their show. We're not getting involved in the day-to-day operations of company, but we do feel like we can be very helpful. We're very well connected in the insurance industry. Maybe one of our 20 investors could be a customer of the startup, or a product manufacturer for a company that's a distribution company. We really value strategic venture capital, where we connect the startups with the incumbents, the insurance companies. Series A is great because the companies already have revenues. They already have customers. We can diligence the customers. We can learn about the companies. So it's not a pure startup that's just on the drawing board that's very hard to diligence. And that's really our expertise is in the industry. But Series A, we can also invest at a low enough valuation. Company doesn't need to be a unicorn, $1 billion valuation for us to do very well, right? If we invest in a company at a $30 million valuation and it's sold at 300, we've made 10 times our money. Those kind of exits are much more common than companies that do IPOs at billions of dollars of valuation.
Right.
Although we've had some of those and been very fortunate.
Yeah, that's very nice. How big of a company is IA Capital Group? How many employees do you have, and how many offices?
We do everything out of New York, but we invest throughout US and Canada. Our core team is 7 people, and then we have another 5 that are advisory partners. So there's 12 of us in total. And last year we made 14 investments, 7 brand new investments and 7 follow-on investments in companies that we had previously invested in. So we're well staffed. Yeah, it's a lot, but it's not huge either. We look at about 200 companies for every one we invest in. So I have to tell you, the Zoom economy has been very helpful for that, because it's cut down meeting 1,000, 2,000 companies a year across our team. It's been much more efficient to do it first meeting in Zoom than in person.
How many of those meetings, and there's a couple different questions I want to ask you here. How many of those meetings do you attend?
Me personally?
Yeah, those first intro meetings.
I do fewer of the first meetings, and my team will vet the first meeting. And then if it gets past my team member, then myself and my partners, Rick Vitone and Matt Perlman, and I are the 3 members of the investment committee. So we'll get the investment committee involved. But every day somebody approaches me and says, "Hey, Andy, look at this startup." So I do plenty of first meetings too, but I'm not infinitely scalable. It's what the team is there for.
Is there really that much going on that your company can see that many startups in a year? That's a stunning number.
I think a fair amount are not quite ready for Series A, but we like to meet them. If they're a seed company, maybe they have $500,000 of revenue. They're not at the $1 to $2 million minimum that we like. We like to meet them, get to know them, and then if they're a good company, they'll grow into that revenue number, and then we'll have a leg up to invest in them. So we'll meet with promising companies, founders that we consider have a bright future, even if it's too small for us currently.
One of the things that we don't usually talk about when we have a VC on is it's a pretty competitive business, right? Yeah. There's lots of inventory, but there's probably not lots of really intriguing inventory. How do you compete in that world? We
compete, but we're also collaborative, right? So a successful startup can have many different investors. Nationwide Ventures is the entity we've invested with most, co-invested with. So we've had 5 different investments with Nationwide. And then there are plenty of other insurance companies or other VCs. We've had 3 or 4 different investments. So it's collaborative, but a mediocre startup will take money from anybody. The highest quality startups, you really do have to compete and convince them to take your money. So that's why our strategic venture capital model comes in. So we say you could take money from, and you've had strategic venture capital. There's people we respect a lot. Liberty Mutual Ventures, for example, we respect them a lot. You take money from Liberty Mutual Ventures, you're connected into Liberty Mutual. You take money from us, you're connected into 20 different insurance companies. So we think that's a superior model.
That has to be intriguing. You said something earlier that I'm very interested in. I had a professor that used to talk about this when I got my MBA, and that was how much of success is art and how much is science. And I would think that the art is the more important piece when you're making these decisions, not to minimize the numbers and the analysis, which is of course critical.
Right.
But there's lots of people. It seems to me there's many qualified people that can run the numbers.
Right.
But the art is a far smaller number.
I agree with that. Every venture firm has a different approach, a different philosophy. We don't try to time the market. So much of insurance you talk about, it's a hard market, it's a soft market for pricing. We don't really look at that much because we're going to hold these companies for 5 years. What matters is what's the market going to be like 5 years from now when it's ready to monetize, and who knows what it's going to be like. Like, we look for long-term trends. So people buying insurance through digital channels is a long-term trend, and people buying it at the country club through a personal friend, that's happening less and less each year. And digital distribution is increasing in market share every year. So that's an example of long-term trend. We also invest in fintech and people, making purchases with cash. That's going down each year, and using electronic means to, buy something, whether it's PayPal, Venmo, or something. Those are long-term secular trends that we just like to, we believe in and we like to invest in. So that's just part of our philosophy. So we do look for investments, in particular in areas that we're focused on. I'll give you one example of a company a company called Matic. It is a digital personal lines distribution company. So they sell homeowners insurance, auto insurance, et cetera. Instead of getting their customers through ads, like on Google ads, Facebook ads, they team up with big financial institutions, mortgage companies, and get their leads that way. So it's a B2B2C model, but we think it makes a lot of sense. It's sustainable. They have these valuable partnerships, and it's, anybody can pay up for a lead, but if you have, large banks and others as partners, we think that's a superior way to originate insurance. So it's just an example of what we look for.
Are they an MGA?
They are not. They work with over 40 different insurance companies.
Oh, wow. We have a lot of different guests on in different stages of the InsureTech world. We have technology companies who are in insurance, and then we have insurance companies who do technology, right?
Right.
What are you looking for? Are you drawn more to the technology that has a space in insurance, or are you more interested in those who have this deep insurance knowledge or insurance base that also have a technology?
We definitely invest in both. Some of our CEOs, entrepreneurs, they come from insurance background, but they know technology, and some are the reverse. Some are technology geeks that have focused on insurance because they think it's an industry that's very ripe for disruption. It's important to us that some people on the management team have very deep knowledge of insurance. So if the CEO is a career tech person, we'd like the number 2 person to be from the insurance industry, for example. There's just so much regulatory compliance, specialized knowledge that you need. But we do like disruptors, right? We want companies that are unique, business plans that we haven't seen before, people that really want to shake up the whole industry. But by the same token, we're not a deep-pocketed investor. $5 million investment be a lot for us or typical for us. We're $3 to $5 million, maybe check size on investment. So we want people that can change the world, but they don't need $100 million of capital to do it.
So what drew you to a company like Bolt?
Bolt was our first pure InsureTech investment, 2006. That's a long time.
That is a long time.
So that's a prior. The Bolt today is Bolt Tech, right? So this is like Bolt version 1.0, which eventually became, I guess, the U.S. operation of Bolt Tech. So I can't really speak too well to the company today, but yeah, Bolt was early in insurance technology, technology out of Israel, and we were impressed by it. They're doing things that other people weren't doing in applying modern technology like cloud computing, big data to the industry, and we thought it was a great investment. But Bolt eventually got acquired by this private equity firm in Asia that turned it into Bolt Tech. So we're not part of the current iteration. I don't want to claim that we are.
How about Flyreel? What was intriguing there?
Yeah,
they've of course exited this
right.
Just in the past 12 months, right?
We sold it. The company was sold to LexisNexis, and we had a nice outcome on that. Flyreel is for property, really for homeowners, to do with underwriting and claims. So it has an app where you can take your phone and walk through your house, and it guides you. And instead of an inspector coming to your house, you can do it all through the app. And I did it on my home and walk through it, and it was very valuable. And I said, this is a great, and it's not just me who makes a decision, it's my whole team, but we all decided Flyreel was a great technology. We have a whole record of it. If you take for example, you snap a barcode of your refrigerator. Like if my house burnt down, I couldn't tell you what model refrigerator I had or something like that, but now it's all recorded digitally. So we thought it makes perfect sense. It's so much easier than inspector coming, and Flyreel is successful. But one challenge startups have is they're selling one product at a time. Mm-hmm. And sometimes it's so much easier for a company like LexisNexis has a whole suite of insurance-related products. They can sell 20 products at one time. So I think it makes a lot of sense for it to fit into the larger suite of products that they have.
Have you ever had somebody exit, somebody you invested in exit and then come back to be reinvested in?
We have one entrepreneur that we've invested in twice. It's on our fintech side, not our InsureTech side, but if you have a second, it's really an incredible story.
Please.
Sosa brothers, from Mexican immigrants from Texas, in Austin, Texas, started one of the first prepaid card companies ever called NetSpend. So you go to 7-Eleven or Walmart, you buy a Visa MasterCard, that's already preloaded on it. So NetSpend took off. And these guys, from a company with nothing, we invested in them. We were the largest investor in NetSpend. Eventually, the company went public in 2001 and was sold for over $1 billion. But meanwhile, those Sosa brothers had a parting of the ways with the owners, the majority owners or the large owners of the company. That wasn't us. So they were kind of out of the company by the time it went public. So lo and behold, a giant global payments company, Global Payments owns NetSpend today, put it up for sale. And these Sosa brothers, who were backing their next payments company, Rev Worldwide, Rev is a small company, said, hey, let's buy NetSpend for $1 billion. And I'm like, well, you don't have $1 billion. You don't have anything close. How are you going to do that? They managed to get private equity money and debt, and these two brothers bought back their company that they started for $1 billion this year. It's an incredible story.
Oh my gosh, that's amazing.
That's amazing. And how goes it?
This is just a brand new. They have a lot of work ahead of them. They have to run this giant company now and integrate it and manage in the future. So I'll come back in a few years and report on how it's going. But to have left the company under not the best terms and then to go back and buy it back, it's really incredible.
So can you share, I mean, I'm sure, because of the amount of time that you spent in the space, you have all kinds of great stories.
Yeah.
Can you share, I'm interested, and I know that you've probably been asked this question so many times. Yeah. So I'm trying to put a little bit of a different spin on it, and that is how things have changed. InsureTech in 2010 looks different than InsureTech in 2022. Can you share an interesting story from the past about that would illuminate what you used to be able to do then that it's just different today?
I think more dollars have rushed into the industry and in venture capital too. I think that we started an insurance company called Homeowners of America with only $5 million of paid-in capital. We sold it last year for $100 million. So the 5 turned into 100 is a great investment for us. But in the meantime, you can't start an actual insurance company for $5 million anymore. If you want to get an A rating, for example, you're talking hundreds of millions of dollars. So I think the barrier to entry in terms of capital has gone up. If you're a direct-to-consumer company and you want to advertise nationwide, whether you're fintech or InsureTech, that's a lot of money. And I think that's part of the reason these consumer-facing public InsureTech companies like Lemonade or Oscar Health have not done well, because they require a ton of money to acquire customers. So they're significantly unprofitable. And now in this marketplace in 2022, profitability is more important than revenue growth, and they're trading. Both of those companies are down, 80, 90% from their peaks. It's like a bloodbath for a lot of these public companies, especially the ones that are direct to consumer. And the whole industry is thinking about that. And we've been very fortunate. We don't have any public InsureTechs or any public companies in our funds. We had a fintech company, Marqeta, went public last year, and we distributed all the stock out to investors last year. So we started the year with no public exposure, which was really great for us. It's a tough time out there. So I think what happened is, over the last 10 years, to answer your question, it required a lot more money to get a company going, to be a leader. And now the market says, well, that's great. You started a Hippo or Lemonade with hundreds of millions of dollars, but now all I care about is profitability. And these companies are being valued at a lot less than all the money that has been paid into the company. So investors are looking at losses. We never really believed that putting hundreds of millions of dollars into an InsureTech is the right strategy. We always thought the best companies don't need to be insurance carriers. They can be service providers, brokers, agents in the industry, and don't need the huge capital bases. But the price to entry to really compete at especially the carriers has really gone up over the years, and I don't think it's served the industry very well. So I'm hoping the next category killers in InsureTech are data analytics, AI, claims technology, underwriting technology companies that don't need hundreds of million dollars as for a capital base. They can just be more service provider companies, can change the world in insurance, but on a more cost-effective way.
Can these companies come back? Your Lemonades, your Hippos. I mean, is there a path for that they come back and that they start regaining, market value? I
personally think that if you bought, and I'm not trying to give investment advice at all, right? I invest in private companies, but if you bought like a basket of all these public fintech, InsureTech companies at these low valuations, you'll probably do very well over the next 5 years. Some will go up, some more than others. But will they get back to where they were? That's a very high bar. Something's down 90% has to be 10x appreciation to get back to where it was. That's very hard. But I think I personally think that they're oversold.
Is there a market where one of these larger long-term companies comes in and buys these companies? I mean, can that be done?
Incumbents.
Yeah. Incumbents, right? Like a giant incumbent, could it come in and say, hey, we love your technology. We love where you're going. We can make you profitable. Let's just suck you up.
I think it can happen. But, if you're a $10 IPO, like these SPACs were, and I know like Root and Hippo had these reverse stock splits, but, their $10 stock is can be like 50 cents today, right? If it didn't do the reverse split. So what's somebody going to offer? If they offer 100% premium, they're paying $1 on something that went public at $10. That's just hard. It's hard for the companies to agree to. It's hard for buyers and sellers to find a fair price when something's down so far like that. It could happen though.
It could. And buyers thinking, hey, this is a great deal. But the seller's like, no, I can't.
Right.
I can't. We're at $5 billion, market value. Yeah.
The better answer is these companies need to get to profitability as quickly as they can. And
that's what they're focused on, right? Everything you read is profitability. It all changed from growth to profitability.
Right.
And why did that happen? Was there a memo that went out and said, we don't care about growth, we just want you profitable? All of a sudden it changed. What happened? I
think that part of the fault is with investors, and not investors that write $5 million checks like myself. It's the investors that write the $100 million checks. They're like, we can invest in a pre-IPO company and it'll go public in 1 year and we'll double our money. Those guys have all gone away. That's not a good model. So I think that too many of these CEOs were just listening to the investors and saying, oh, this is what you need to do. You could raise a lot of money. You can go public. Instead of, they should have just been focused on the profitability of the business.
So this kind of leads into the conversation of InsureTech 2.0, which it's funny, you hear that term kicked around and you ask different people who are deeply involved in it like yourself, and you get different answers. What is InsureTech 2.0? What does it mean? So it means different things to different people. It's defined differently. There's no standard definition. However, as InsureTech continues down the road, things are clear, as we were just talking, things are clearly changing. What was sexy 2-3 years ago is not so sexy anymore. What's sexy now? What does 2.0 hold for us if, like you said, the financial pressures are forcing certain companies to rise, or enabling and passing on other ones who don't fit into the current state of the world?
I think it's models like embedded insurance are the future, and I'm not the only one that thinks that. So if you think about it, the big insurance carriers, Allstate or Prudential, they're not going away. They're still going to be writing most of the business even 5-10 years from now. And the biggest distribution companies, the consumer-facing companies, those are really tech firms. There's nobody out there that can reach more consumers than Google, Facebook, Amazon, for example. And we think over time they're going to be selling insurance, personal lines insurance.
Right.
So what we want to invest in is the connectivity between the two. Who's going to connect the Allstates with the Amazons? They're going to need, that's a lot of technology that's going to need to be built. It's going to need to be very specialized. It's going to companies that understand the regulatory compliance areas. And a lot of that is just embedded insurance. So embedded insurance would be embedded, an insurance offering that's embedded in a website that maybe you don't think of as selling insurance, right? So you go to American
like travel insurance.
Exactly. I was going to say American Airlines, you buy travel insurance. But why wouldn't over time, every consumer-facing website, offer some type of insurance is related to just about it, every aspect of commerce. So we think that's a big, maybe the biggest 2.0 trend out there. So we're spending a lot of time investing in that area. An investment we made this year is a company called Efficiency. They focus on the life insurance side, but that's their whole model, is to build the technology between the distributors, which don't have to be traditional insurance distributors. It could be, a fintech website, and the life insurers. So, it's their technology that can link those parties together. So that's one of our biggest themes we see in the future. I'll give you one other important theme for us, and that's climate change. So you can throw out the old models that model flood insurance, wildfire, these type of natural events that depend on climate conditions. So we think there's great opportunity for new entrants that have new ways of thinking about these types of risks. Not necessarily that we want to be taking the wildfire risk, but we want to invest in companies that know how to analyze it, know how to add value to the insurance companies that do take the risk. Incumbency is not really an advantage if the old models don't work anymore, right? So it's a real advantage for the startups, I think, in those types of areas.
Right. If your risk is evolving, like with climate,
right,
then your underwriting has to evolve along with it. You can't underwrite. I mean, we're here in California now. You can't underwrite here the way that you underwrote, 40 years ago. Exactly
true. So just to mention a couple of our portfolio companies, the wildfire company is Delos that we've invested in, and the flood company is Rethought.
I would like to go back. You brought up Amazon. You brought up Google. Yeah. Do you ever meet Amazon, Meta, Google in the investment world of InsureTech? Are they actively investing in InsureTech?
Not really. Maybe on the margins a little bit.
Ring.
Yeah, that's right. That's right.
That's a good example.
I think that's a good example. They're interested in maybe some of the cyber risks, but again, bread and butter, P&C, we don't really see them around.
I wonder why, because everyone assumes that they're going to start selling insurance, right? Everyone assumes that Amazon is going to have a homeowner site and I can buy insurance through them. I mean, I wonder why they're not, or is it a whole different angle? Just like you're talking about, they're looking at that connection between the two.
Yeah, I think it's regulatory issues, but I think those are, those are hurdles that can be overcome over time. Yeah. That's not going to keep them out forever. And you see that in other financial services, right? You see Apple is big into financial services now with,
Oh, that's right.
Paying with your phone, with your iPhone, for example. Yes. So we see it in other areas of fintech. We think it's going to come to insurance. It might be easier a little bit to start in other countries where you don't have 50 state regulators like you do in the U.S. But in our longer term thinking, we want to invest in companies that won't get crushed by these companies that, we want our startup to be able to work with the big tech companies and not be crushed by them.
I like to say, and tell me if you would agree with this, that the companies that are making the tools for the other companies to use, right?
Right.
That I think is a very intriguing 2.0 play. Is we're not looking to sell the insurance, we're looking to help you sell the insurance.
Yeah, I agree with that. I know you just had Dan from Socotra on.
Yeah, Dan.
Example, right? I mean, I think that these tools are very valuable for the industry. What I would say is there's not going to be 20 successful companies in each vertical for these tools. So there are going to be leaders, 1 or 2 or 3 companies that build these tools that get adopted across the industry. A little bit more of a winner take all, as opposed to insurance distribution, which there are many brokers, agents that can be successful out there.
Do you ever end up working with private equity?
They call me every day to they want to buy what we have, right? So it's an exit. Just like we talked about, Bolt was bought by a private equity company in Asia. It happens. It happens pretty frequently. One of our companies now in discussion with private equity. The thing about private equity, they are earnings focused because they'll want to lever the investment, and in order to have leverage, you need cash flow. Once a company is generating a decent amount of cash flow, then the private equity guys really get interested to buy what we have. And so we really have 3 ways to exit our investments. One is just strategic sale in the industry. Second is a financial buyer like private equity. And the third would be IPO.
How many of them go to IPO? How many have you had go to IPO?
We've made 8 payments investments and 5 have been public companies. So it's a huge ratio there.
Yeah. Congratulations.
Number of companies, maybe 20% of our companies, 25% go IPO, but in dollar amounts, that 20% is kind of more than half of all our realized gains. Yeah.
In the few minutes we have left, I want to touch on a couple more topics. I'd like to touch on crypto.
Sure.
We've had some various people on, Pascal Millar, others. I just find crypto so interesting because it's so complex. Right. I guess you could do parametric insurance for crypto, but anyways, how do you feel about crypto? I think you guys are in crypto. What are your thoughts there?
We certainly looked at a lot of investments on it, more applicable to our fintech side. Crypto solutions for InsureTech. We have not really seen many quality companies. I think there's an opportunity for entrepreneurs to focus on it a little bit more. Our insurance company investors are generally, on the conservative side, and they're not ready to dive into crypto solutions, even blockchain type solutions that don't have to do with tokens. They're still not, so they're hesitant. But I think there's a real opportunity. I think there's opportunity on the loyalty reward side of insurance to use cryptocurrencies. The business-to-business solutions, I'd say less so. You can tokenize assets or tokenize insurance contracts. I think that's going to take a long time. But there's some smart people working on it. But all in all, I would say insurance adoption of crypto solutions is pretty small percentage of what we look at.
What about cyber? Is that on your radar right now?
Yeah, cyber is huge. We just made a cyber investment. We led around in a prominent cyber company. I don't believe it's been announced yet. We like cyber. The nice thing about cyber, really from our standpoint, is you really can't, if you're an insurer, you really can't take that much risk because the risks are all correlated. It's not like property insurance where, a California earthquake has nothing to do with a Florida hurricane, right? Those are completely uncorrelated events. Cyber, you could have a worldwide event easily. If you're an insurer, you're just not going to take that much risk. It means that there have to be a lot of different players in the industry. There's not going to be anybody that dominates it. You're going to need a lot of different brokers and distributors. You need a lot of data. So we like cyber, but I have to say that the valuations of some of these, you might have seen Coalition reported a $5 billion valuation. We don't believe in, those types of valuations. We'll invest in companies that are worth 30, 40, $50 million valuations, not billions. But with that caveat, we really are bullish on the sector.
I have one last question for you, and that's about HOA, Homeowners of America. Right. When I was on your website and I saw that you guys were in HOA, Lee and I work on the claims side. We work for Alacrity. We're large service provider. And for several years, we had HOA as a customer doing their claims work, right? Just this little bitty insurance company that was in a lobby of a building. They were this little thing. How in the world did an InsureTech VC get him? And with great success, get involved with HOA?
Well, the answer is that our normal check size, $5 million, we were able to start an actual insurance company. The team came from us, from an experienced team, and they said, "Hey, we can execute this business plan for the check. Our $5 million might buy 10% of a $50 million InsureTech. Here, this $5 million could own almost all, except for the equity the team had, could own the whole company." And we said, this is a great idea. And the team, I give Spence Tucker and the management team all the credit. They executed very well. It's profitable company for many years. We reinvested the profits in the business, and it grew from nothing to $400 million of premiums. Our $5 million turned into $100 when we sold it to Porch Group last year. And it started tiny, but I think it became the largest independent homeowners insurer in Texas. So we're really, really proud of that.
That's amazing.
It is a little bit more insurance than InsureTech, but it's the same, startup type mentality that we have in all our companies. Yeah.
But so your company is willing to be opportunistic. You're not hard and fast. You saw a great opportunity. How much technology they were using was not necessarily the relevant question.
I think that's right. But, within our space, we're not, we were going to stay within our lane of insurance and financial services. We're not going to do anything outside of that. But within those space, we do like to be opportunistic.
So if Lee and I start an insurance company in California and we could do it for $5 million, we should call?
I think you guys should. Claims is an interesting area. I know you guys know the Snapsheet guys well, right? It's a nice. Claims is a great area to do a startup in.
And we absolutely cannot let you go without bringing up Snapsheet.
Yeah, we have to. We have to talk about.
You guys
Snapsheet.
are early. Not super early, but relatively early to Snapsheet. Were you Series
A? A, B round. We're and we're one of they have a lot of good investors. We're just one of several on the cap table. They've done a great job. They are the leader, right, in auto insurance claims, bar none. It's really nice to be invested in a category leader. And there's a little bit of the Chicago mafia. We have another company, Clear Cover, which is an auto insurer in Chicago, and those two companies do business with each other. And it's just a lot of synergies between Snapsheet and our other investments.
Well, let us first say thank you very much. It's not only was great to have you on, a great interview, but it's a privilege and an honor to have on not only a longtime member of the ecosystem, but also a chess champion.
That's right.
Let's not forget that. And next time we have you on, we're coming to San Diego.
Yeah, please do.
You should have never told us that because we're going to stay in your house and everything.
You guys are welcome anytime. real pleasure to be on the show. I can't wait to listen to your future episodes.
And just last thing, real quick, shout out to Ali Savavi.
Oh, yeah.
Yeah.
Thank
you, Ali.
Ali's company's Kovu. He's doing really well.
Okay, thank you. See you next time.
All right. Thanks a lot, guys.
What a really nice, wonderful man.
He was very nice. It was great for him to be on. We got to talk all about some fascinating things today.
Great stuff.
I was very happy to have
not
him
to
on.
mention chess. Guy's like a chess maven.
Yeah, the whole time I wanted to ask him if he ever goes to those parks, like Washington Square when he's in New York and plays. But I didn't ask. In my head,
what we need to do? We need to have the F&O InsureTech chess tournament.
Yeah. Okay. So Andrew will be on. Who else?
Andrew, we're going to have to handicap Andrew. We're going to have to cover one of his eyes or something, or tie a hand behind his back.
Yeah, I would play him, but I think he would beat me in about 3 moves.
More than likely. And speaking of a few moves, we're going to move to the end of this podcast and thank our producers and thank my co-host, Mr. Lee Boyd.
Thank you, Rob Beller.
And thank you all for being with us for another year as we say goodbye slowly to 2022 and get ready for 2023. We thank you for being with us and for being the most important part of our ecosystem, of the F&O InsureTech ecosystem. And until next time.
Goodbye, everybody.